Well, I've been reflecting a great deal on retirement recently. Not my own retirement, I'm 94, and I have no intention of retiring, but retirement as a concept. How people get ready for it, how they pay for it, what they handle well, and where they go wrong. And I've observed something concerning. Most people plan for retirement in a completely backward way. They work for 4 decades, put aside some savings, and then simply assume it will be enough. There's no clear plan. There's no proper asset mix. There's only hope. But hope is not a plan. And when you reach 65 and suddenly realize you don't have enough money to stop working, it's too late to correct the problem. Time is gone. The years of compounding are gone. You're trapped. That's why today I want to discuss the 5 assets you must own before you retire. Not assets you should consider, assets you must have. These are not optional. If you want a stable and comfortable retirement, these 5 assets need to be part of your portfolio. I'm not going to talk about complex hedge funds or confusing investment strategies. These are straightforward, time-tested assets that have worked for decades. Assets that produce income. Assets that help protect against inflation. Assets that allow you to retire with confidence rather than anxiety. So let's begin with the first and most important asset you need before retirement. A diversified portfolio of dividend-paying stocks from companies with long records of raising their dividends. This is the backbone of retirement income, not bonds, not annuities, but dividend-paying stocks. Let me explain the reason. When you retire, you still need income. You're no longer earning a paycheck, so your investments must provide cash flow. There are 2 ways to do that. You can sell pieces of your investments, slowly reducing your principal, or you can receive dividends without selling anything. Which option sounds better? Clearly the second one. When you sell shares to fund retirement, you're on a timer. Eventually the money runs out. If you live longer than expected, you face serious risk. Dividends, however, can last indefinitely. You keep ownership of the shares. Companies pay you every quarter. And if you own the right businesses, companies that raise their dividends year after year, your income grows over time. Consider examples like Coca-Cola, Johnson & Johnson, Procter & Gamble, and McDonald's. These companies have paid dividends for decades and increased them consistently for 20, 30, even 50 years or more. That's the type of asset you want before retirement. Not speculative growth stocks or high-risk ventures, but stable, reliable businesses that steadily raise dividends and can pay you for the next 20 or 30 years of retirement. Here's how this works in practice. Suppose you retire with $1 million invested in dividend-paying stocks yielding 3%. That gives you $30,000 a year in dividend income. For most people, that alone isn't enough. But these aren't flat dividends, they grow. Assume the dividends increase by 7% each year. After 5 years, your income rises to around $42,000. After 10 years, it's roughly $59,000. After 20 years, it reaches about $116,000. Your income doubles, triples, and even quadruples throughout retirement. While Social Security struggles to keep pace with inflation, dividend income continues to move ahead. That's the strength of dividend growth. And here's the best part. You never had to sell a single share. Your original $1 million remains invested and continues to grow. You can leave it to your children. The dividends were pure income, generated from the profits of strong businesses. I've relied on dividends throughout my adult life. Berkshire Hathaway doesn't pay a dividend, but I own other companies that do. And that income has increased year after year. It's one of the most dependable income streams available. So that's asset number 1, a diversified portfolio of high-quality, dividend-paying stocks. Not just any dividend stocks, but strong companies with durable brands, competitive advantages, rising earnings, and long histories of dividend increases. Build this portfolio before retirement. 10, 15, or 20 companies across various industries and plan to hold them long-term. This becomes your retirement income engine. Now let's move to the second asset you need before retirement, which is different from the first. A low-cost S&P 500 index fund that you leave untouched. You might be thinking, didn't you just recommend dividend stocks? Yes, and you still need both. Here's why. The dividend portfolio is your income source. It provides regular cash flow that covers living expenses. The index fund, on the other hand, serves as your protection against inflation and your long-term growth tool. Even with rising dividends, you may face high inflation, unexpected costs, or a longer retirement than planned. You need assets that continue to grow in value and can be accessed if necessary. An S&P 500 index fund gives you broad exposure to the 500 largest companies in the United States. Over long periods, 20 or 30 years, it grows alongside the economy and has delivered consistent results. It requires no active management and no stock selection. You simply own it and allow it to compound. It acts as your backup, your safety cushion, and your long-term growth engine that keeps working even after retirement begins. Here's how I look at it. The dividend portfolio functions like your checking account. You regularly draw income from it. The index fund serves as your savings account. You leave it alone and only access it if there is a real emergency. Imagine you retire with $700,000 invested in dividend stocks and another $300,000 in an S&P 500 index fund. The dividend stocks provide steady income, while the index fund remains invested and continues to grow. Over 20 years, based on historical returns, that $300,000 could grow to roughly $2 million. During that same period, your dividend stocks have been paying you income the entire time. You've lived comfortably, and now you're left with a large nest egg that has grown significantly. That's the benefit of combining both strategies. Dividends provide income, and index funds deliver growth. Together, they form a retirement portfolio that is extremely resilient. So that brings us to asset number 2, an S&P 500 index fund that you hold long-term and do not touch except in true emergencies. The third asset you need before retirement, and this is essential, is real estate that produces rental income. And to be clear, I'm not referring to your primary home. Your house is not an investment, it's an expense. While it may increase in value, it doesn't generate income. It costs money for taxes, insurance, and maintenance. What I mean is rental property, residential, or commercial real estate that creates monthly cash flow. This is one of the strongest retirement assets you can own. The reason is simple. Rental income is very stable. People will always need places to live and operate businesses. And rents generally rise with inflation. As your expenses increase in retirement, your rental income often increases as well. On top of that, real estate adds diversification. Real estate doesn't move in sync with stocks. When the stock market drops, rental properties usually continue producing income. Tenants still pay rent. That consistency is extremely valuable in retirement. Here's a realistic example. Suppose 10 years before retirement, you buy a rental property for $300,000. You put down $60,000 and finance the rest. The property brings in $2,000 a month in rent. After covering the mortgage, taxes, insurance, and maintenance, you net about $300 per month. That doesn't sound impressive at first, but over those 10 years, you're building equity as the loan balance declines. The property is likely increasing in value. Most importantly, you're nearing retirement with a property that is almost paid off. By the time you retire, the mortgage is paid off or nearly so. Now that same property may generate around $1,500 per month in net income. That's $18,000 a year in stable inflation-adjusted income. Own 3 similar properties and you're earning $54,000 a year from rentals alone. Add dividends and Social Security and retirement starts to look very manageable. Now I understand that not everyone wants to be a landlord. It requires effort and there can be challenges. But for many people, that effort is worth it for the dependable income real estate provides. If direct ownership isn't appealing, there's another option, REITs. or real estate investment trusts. These companies own and manage properties and distribute most of their income as dividends. You get exposure to real estate without dealing with tenants or maintenance. Either way, real estate belongs in your retirement portfolio. It has proven itself for centuries as both a store of value and a source of income. Don't retire without it. That's asset number 3, income-generating real estate or REITs, providing steady cash flow that rises with inflation. The 4th asset you should own before retirement is Treasury inflation-protected securities, known as TIPS or I-bonds for shorter-term needs. I know bonds aren't exciting, and traditional bonds perform poorly during inflation. But TIPS are different. They are specifically designed to protect against inflation. Here's how they work. The principal value of a TIPS bond adjusts with inflation. If inflation is 3%, your principal increases by 3%, and you earn interest on that adjusted amount. This means you don't lose purchasing power. In fact, you gain slightly because you earn interest on top of the inflation adjustment. Why is this important in retirement? Because inflation slowly erodes fixed income. If you retire earning $50,000 a year and inflation averages 4% for 10 years, you lose about 1/3 of your purchasing power. That same $50,000 only buys what $33,000 did when you first retired. That's a serious problem. Your income stays the same, but your standard of living declines. TIPS help prevent that. They ensure that at least a portion of your portfolio keeps its purchasing power regardless of inflation. That protection provides real peace of mind in retirement. I'd suggest allocating around 10 to 20% of your retirement portfolio to TIPS, not more than that. Stocks and real estate are better for long-term growth, but you want enough TIPS to add stability and inflation protection. Think of TIPS as your defense. Stocks and real estate are your offense. They grow your wealth. TIPS protect what you've already built. That's asset number 4, TIPS or I-bonds, your inflation shield in retirement. Now we reach the 5th and final asset you should have before retirement. And this one often surprises people. A paid-off home or very low housing costs. Earlier I said your house isn't an investment, and that's true. But owning your home outright before retirement is one of the smartest financial decisions you can make. Here's why. Housing is usually your largest expense. If you're paying $2,000 a month in rent or mortgage during retirement, that's $24,000 a year. Over a 20-year retirement, that adds up to nearly $500,000. If your home is paid off, that cost drops significantly. You're left with property taxes, insurance and maintenance, maybe $6,000 to $8,000 a year instead of $24,000. You've just freed up about $16,000 a year. That immediately lowers the amount of income you'll need in retirement. If you originally thought you needed $60,000 annually, but your home is fully paid off, you may only need around $45,000. That goal is far more realistic. On top of that, low housing expenses give you flexibility. If your investments have a weak year, you're still fine because your housing costs are very low. If unexpected medical bills come up, there's space in your budget to handle them. Let me be very clear here. If you're close to retirement and still have a mortgage, eliminating that mortgage should be your highest priority. Not paying extra on your car, not booking expensive trips, not remodeling your kitchen. Focus on paying off the house. I understand that sometimes the numbers suggest investing instead of paying down a low-interest mortgage. From a purely mathematical view, that can be true. But retirement isn't only about numbers. It's about peace of mind. It's about safety and stability. Knowing your home is fully yours, that no one can take it away, that you'll always have a place to live. That sense of security is worth far more than gaining an extra % or 2 in returns. If you're younger and reading this, here's my advice. Buy a smaller home than what the bank says you can afford. Choose a 15-year mortgage instead of a 30-year one. Pay it down aggressively. Make additional payments whenever you can. Your objective should be to own your home outright by age 60 at the latest, ideally sooner. That gives you 5 to 10 years before retirement to grow other assets without a mortgage draining your savings. If you're older and still carrying a sizable mortgage, you have two options. Either commit to paying it off before retiring, even if that means working a few more years, or plan to downsize at retirement to remove the mortgage entirely. What you cannot do is retire with a large mortgage payment and hope everything works out. That's a serious financial mistake. You're entering retirement at a disadvantage from day one. So that brings us to asset number 5, a paid-off home or extremely low housing costs. It's not an asset that grows in value for income, but it dramatically lowers the income you need in retirement. Now let me recap the 5 essential assets, because they form the base of a secure retirement. First, a diversified portfolio of high-quality dividend-paying stocks. This is your main income engine designed to grow over time. Second, a low-cost S&P 500 index fund that you leave untouched. This provides long-term growth and protection against inflation. Third, income-producing real estate or REITs, offering steady cash flow that adjusts with inflation. Fourth, Treasury inflation-protected securities, which act as your defense against inflation. Fifth, a paid-off house or very low housing expenses, which significantly reduce how much income you need. Now let's talk about how much to allocate to each category, since that's what most people want to know. What percentage should go where? Here's a general framework. For someone planning to retire within the next 5 to 10 years, this is a guideline, not personalized financial advice. Allocate 50 to 60% to dividend-paying stocks. These are your income producers and should make up the largest portion of your portfolio. Put 20 to 25% into an S&P 500 index fund. This is your long-term growth engine, something you won't touch for many years, possibly decades, quietly compounding in the background. Set aside 10 to 15% for real estate or REITs. This adds diversification and extra income without overexposing yourself to property. Keep 5 to 10% in tips, enough to protect against extreme inflation without sacrificing too much growth. And then there's your paid-off home. It sits outside your investment portfolio, but it plays a critical role in your retirement security. These percentages can change depending on your situation. If you're more conservative, you might prefer more tips and fewer stocks. If you're healthier and more aggressive, you might lean towards stocks and reduce tips. But the most important thing is owning all 5 asset types. They work together. They balance one another. They protect you from different risks. Dividend stocks provide rising income. The index fund delivers long-term growth. Real estate offers inflation-adjusted cash flow. Tips add stability. And a paid-off home keeps expenses under control. Together, these 5 assets create a retirement plan that can withstand almost anything. During market downturns, real estate and tips provide stability. During inflation, dividend stocks and real estate adjust upward. Over a long retirement, the index fund continues growing. When expenses rise, a paid-off home keeps them manageable. That's a retirement built on confidence, not wishful thinking. Confidence based on assets that have performed well over many decades. Now let me address some common mistakes people make with retirement assets. Because knowing what to own isn't enough. You also need to know what to avoid. The first mistake is putting too much money into bonds. Many people assume retirement means playing it extremely safe, so they move heavily into bonds. But bonds don't grow. They don't protect against inflation. In times of high inflation, they can even act like certificates of confiscation. You need growth in retirement because it can last 30 years or more. Bonds alone won't get you there. You need stocks and real estate that appreciate over time. The second mistake is not having enough income-generating assets. Some retirees have $1 million in growth stocks with no dividends. Then what? You have to sell shares to cover expenses, which depletes your capital. One market downturn and you're at risk. You need assets that produce income, dividends, rents, interest, so money comes to you without touching your principal. That's how retirement becomes secure. The third mistake is retiring with a mortgage. I cannot stress this enough. Having a mortgage during retirement is one of the worst financial decisions. It greatly increases how much you must save and the risk you take. Pay off your house first, or work a few extra years to do so. Your retirement will then be far more comfortable and secure. The fourth mistake is failing to diversify. Some people put everything in stocks, others, everything in real estate. Diversification is protection. Different assets perform well at different times. You need a mix. That's why I recommend 5 asset types, not 1, not 2, but 5, because together they're stronger than any single asset. The fifth mistake is waiting too long to start building these assets. You cannot create a retirement portfolio in just 5 years. It takes decades. Dividend portfolios need time to grow. Real estate needs time to appreciate and reduce debt. Index funds need time to compound. If you're in your 20s or 30s, start immediately. In your 40s, start without delay. If you're in your 50s, act aggressively and quickly. Time is critical. Here's a roadmap by age. In your 30s, focus on the index fund and starting your dividend portfolio. Real estate can wait. Grow your stock assets first. In your 40s, add real estate. Begin buying tips and pay down your mortgage faster. You have roughly 20 years to retirement. Use them wisely. In your 50s, this is crucial. Aggressively build all 5 assets. Max out retirement contributions. Buy rental properties. Reduce your mortgage. Expand your dividend portfolio. Buy tips for stability. If you're in your 60s and haven't started, you face a challenge. Either work longer to build assets or lower your retirement expectations. There's no quick fix. You've run out of time. Retirement preparation takes decades. You cannot cram it into the last few years and expect results. So wherever you are, whatever your age, start building these 5 assets today. Not tomorrow, not next month. Open a brokerage account and buy your first dividend stock. Open another account for an S&P 500 index fund. Research rental properties or REITs. Buy tips via Treasury Direct. Make an extra mortgage payment. Take action. Assets don't grow on their own, and retirement doesn't wait. I've seen many people reach retirement unprepared. They thought they had time, that Social Security would be enough, and now at 65, they're either still working because they cannot afford to stop or retired, but struggling, stressing over money constantly. That's not how retirement should be. But it can be different. Build these 5 assets consistently and start now. You can enjoy a retirement that's comfortable, secure, confident, and free from financial stress. These assets provide security, peace of mind, and the ability to retire with dignity, not necessarily luxury, but freedom. Here's a challenge. After listening to this, take action. Pick one of these 5 assets today. Buy a dividend stock. Invest in an index fund. Research rental properties. Purchase tips. Make an extra mortgage payment. Just one step. Then keep going. Next week, take another. Next month, another. Build these assets steadily. By retirement, your portfolio can support you for decades. I'm 94. I've seen hundreds of retirements, good and bad. The difference is consistent. Good retirements belong to those who built the right assets. Poor retirements belong to those who didn't prepare. Don't let yours be one of the bad ones. Build these 5 assets. Start now, stay consistent, and retire with confidence, not fear. That's the path. Follow it, and retirement can become one of the most rewarding phases of your life, not one of the most stressful. Thank you for listening. Now go build those assets. Your future retired self is counting on you. Good luck.